Hi, Kathy Campbell here with Coldwell Banker. Today we're visiting with Rick Hutchinson with First Rate Home Loans. Rick's been in the industry for many years and he'd like to share some information today. We've got a lot of changes happening with FHA and conventional loans coming up here in the next few weeks, don't we?
We do.
So educate us, tell us what we should expect is coming up.
All right, thank you, Kathy. Again, my name is Rick Hutchinson and I am with First Rate Home Loans. I'm a mortgage loan officer there. I've been in the business forever, but there are some important updates I want to educate you on. The first is, I'm going to give just a little bit of history. Prior to the year 2008, FHA was the major player in the mortgage market. And then in 2008, they started having some insurance fund issues. And even though they were backed by the good faith of the United States government, they increased costs to do business. And some of those costs were fairly substantial in the early years, as you'll see from the slide that Kathy will have on her screen. Beginning this year, though, FHA is going to be reducing their mortgage insurance fees by 30 basis points. Now, what that means is, in effect, the cost of an FHA loan is going down by about 0.3% in rate, if you think of it that way.
It's a substantial savings.
That is, especially when you consider they already have better interest rates than conventional loans because of the government insurance. You know, they're government insured. Another major thing is happening. In effective May 1st of this year, Fannie Mae and Freddie Mac, the two major conventional lenders, are having cost increases in some areas. And so if you look at the graph on your screen, you'll see some red areas and some green areas. Green is good, red is bad. And so what we're seeing is that in the green areas, pricing is going to be improving. Red areas, it's going to be getting worse. And what's happening here behind the scenes is the government is trying to make it so that more people can qualify to get that first home. And so the green column on the right is first-time home buyers, because you have to be a first-time home buyer to get loans in that category. And then below the credit score of 680, you can see that there's a lot of green there as well. Again, they're trying to open up the market to more people. The unfortunate thing is it's costing the guy in the middle some extra money.
The money's got to come from somewhere.
The money's coming from somewhere.
Those with a little higher credit score, we're seeing some increases.
Yeah. And with regard to debt to income, now when I say debt to income, I'm talking about the relationship between house payment plus monthly debts for things like a car payment or a credit card.
And student loans included in that.
Student loans, So that relationship to their gross monthly income is what we call a debt to income ratio.
Okay.
For debt to income ratios greater than 40%, that affects a lot of loans these days.
So we're talking if it's more than their mortgage, all their other loan payments is more than 40% of their gross bringing home pay.
Yeah, their gross income before taxes.
Okay.
Okay. So if it's greater than 40%, there's going to be a hit of up to 0.3% against the loan amount. So what that means is, let's say you have a $400,000 loan, that 0.3 of a hit is going to equal $1,500 more expense.
Closing costs then?
Closing costs. That can be in the form of cash, or it can be in the form of a higher loan amount that's paying some of those costs.
Okay.
Okay. The bottom line is conventional is getting more expensive. So the other thing we haven't talked about is mortgage insurance on a conventional loan. Some people think you have to have 20% down to get a conventional loan, and that's not true. Since 1957, mortgage insurance for conventional loans has been around, and so if a person has a smaller down payment than 20%, they can get a conventional loan, but they'll pay a fee for that mortgage insurance. And just like the pricing on the interest rates, the higher the debt to income ratio is, or the higher the loan to value ratio is, the more they're borrowing, the cost goes up. Okay.
And that what we call private mortgage insurance.
That's called private mortgage insurance.
Okay.
FHA calls the same thing monthly mortgage insurance, but it's the same concept.
Gotcha.
Okay.
For anything less than 20% down, we have to insure the lender, so if the borrower defaults, that they are insured and they'll recoup their money.
The major difference between the two is FHA has basically a fixed cost on their monthly mortgage insurance, whereas conventional has a cost that increases with risk.
Right.
Okay?
And the other difference is, and also is, often FHA loans, that insurance is there for the life of the loan, where conventional, after they get a certain amount of equity, it falls off.
That's correct for the most part.
Okay.
And so on some of your FHA loans, mortgage insurance goes for the life of the loan. However, it's based on the decreasing principal balance as time goes on, and so it's going down to almost nothing by the end of the loan.
Gotcha. So it decreases with it.
In some FHA loans, just like conventional, the law requires that there's an automatic dropping of the mortgage insurance when you get down to 78% of the original value.
Okay.
Okay?
Thank you.
You're welcome. So, for the consumer...
Yeah, what does it mean? Here we go.
So for the consumer, what does it mean when we look at FHA and conventional and compare them now?
Well, in the past few years, conventional's been the way most people have gone because it's less expensive.
Yep, that's been true. Now that's changing.
Okay.
And so before we go any further, I need to tell you about two major things. There are 5 basic and broad categories of loans we're going to look at on conventional and FHA for that matter too.
Okay.
But you have your high ratio loans that are greater than 95% loan to value, and they go down to, and they go up to 97%, which is a 3% down payment. FHA is a little more conservative. They require a minimum down payment of 3.5% on most of their loans. Not all of them, but most of them.
Okay.
Okay?
So let's say, for instance, we have a $400,000 loan. 3% of that would be $12,000.
Correct.
Down payment. Okay.
Yep, that's right. The other broad categories are, we have what I call 95% loans. Those go from just over 90% loan to value up to 95.
Okay.
The same concept in mind, the other categories are 90%, 85%, and less than 80.
Okay.
80 or less.
And
Okay?
80 or less is when we don't have any private mortgage insurance.
On conventional loans.
Okay.
That's true. The other thing we have to consider is, because of risk-based pricing, you have different prices for loans in 20-point increments on credit scores.
Okay.
And so a 640 credit score, for example, may be more expensive than a 660 or a 700 or a 780. Okay,
Right.
You get the idea.
And there's been times I've had a client very close to one of those benchmarks that, you know, they will work with the lender and will work for a month or so to try to just tip past that
Yeah,
little
get that
credit
tweak.
score. Right, and that's made a
Exactly.
difference in their payment.
Exactly right. So with that in mind, with those two broad things in mind, let's compare them.
All right.
So for your high ratio loans, and also the category of what I call 95% loans, FHA now is just simply going to be better across the board. You're going to have lower interest rates, lower APRs, and APR is an annual percentage rate. That's a formula the government came up with to make it easier for individuals to compare loan costs,
Okay.
to see what's better, the lower rate with higher fees or higher rate with lower fees. It gives them a point of
What's
comparison.
the total cost? Right?
Yeah.
Okay.
And so for 95 and high ratio loans, FHA just wins across the board. They have lower interest rates, APRs, house payments, cash to close is lower. They just win all the way across the board.
That is quite a switch.
That is. If we go to the next category, which is the 90% loan, we get a mixed bag. For credit scores of 760 or higher, conventional is going to win.
Okay.
They're going to be better. For credit scores below 760, depending on different circumstances, sometimes FHA will win, sometimes conventional will win. In general, though, FHA will come out ahead.
Most of the time.
Okay? Not all the time, but most of the time.
Okay.
For an 85% loan, again, we're back to FHA trumping things. In virtually every category with a loan-to-value ratio of between 80.01 and 85%, FHA is going to win the day. The exceptions are, again, if you're over a 760 credit score, conventional will win sometimes.
Okay.
Okay? If you're below that, FHA is going to win. Now, that can make a huge difference in the amount of a loan payment. So if I go back for a minute to the first example I had of the high ratio loan, this is important, I think. On a high ratio loan, let's say you had a house payment FHA of $3,520. With the same credit score, you might have a house payment conventional of almost $4,400. Huge difference.
Wow.
Now, as loan to value ratios come down, they become more competitive. And so at the 85% level, that same house, you might have a house payment FHA of $31.84 compared to conventional of $33.15. Still a fairly substantial difference.
Yeah.
The main concept I want to convey here, though, is rates change every day, and so these payments will change every day. You can't rely on the specific numbers.
This is our snapshot in time right
Yeah,
now.
this is a snapshot in time that I did last Friday.
Okay.
But the general concepts aren't going to change until Fannie Mae and Freddie Mac and or FHA make changes again in the future.
Okay.
And so FHA down to 85%, well, actually down to 80.01%, is going to be very hard to beat unless a person has a very high credit score.
Okay.
Finally, we get down to an 80% loan.
Those with the 20% saved up, right?
That's correct. 20% down. Conventional finally trumps in most of the categories,
Okay.
but not all. And so the major area where they do not trump is cash to close. In almost every instance, in all the credit score ranges, FHA will be cheaper for cash to close for down on closing.
Wow. And by thousands, by?
Anywhere from a few hundred to thousands. Like for example here, with a low credit score, 619, 101,000 FHA versus 106,000 conventional.
Okay.
So
and
again,
a higher credit score would be?
Yeah, a higher credit score, you might have something like, in this case, we're above 760, at 780 plus, FHA might cost 110,000, conventional a little less.
Okay.
Okay. In summary, things have changed. I really believe borrowers should take a close look at FHA. I think they'll be surprised. I know they'll be surprised. I was.
Yeah. Well, you're sharing some news with me.
And so with the recent program changes, FHA is again a winner, like it was before 2008. Okay.
And maybe we can talk about FHA loans. I was in a competitive offer just yesterday.
Mm-hmm.
They're starting to happen again. If a home on the market is priced right and in good shape, you know, we went up against 18 offers.
Wow.
Sometimes in the past, when I've worked with a seller, they have looked more at conventional as favorable over FHA because of the inspections that are required or maybe the time. Do you think that's still a hindrance, or are we seeing FHA being able to process faster and things like that, so a seller would be more comfortable with it?
Okay, that's a very good questions, really.
Yeah.
So FHA is definitely more competitive on the financial side for the borrower. A seller is going to have to look at that because it's going to make a difference.
Mm-hmm.
With regard to inspections, really, in my mind, there hasn't been a great deal of difference there. Both conventional and FHA have wanted to know that the property did not have health or safety issues. And so if there was a health or safety issue on a conventional issue, did the appraiser address it? Yes, just like he did on
If
FHA.
it was drastic, you know,
Yeah.
FHA's got their own little appraisal and inspection that happens. But it hasn't ever been that critical. You know, handrails, chipping paint, it has
Exactly. And in either case, like let's take chipping paint for example. You know, FHA's had a requirement for years for paint, you know, to scrape for full even coverage if paint was in good order. And conventional didn't always require that. And so that was one thing that was in favor on the conventional side. But when it was required, both FHA and conventional expected the safety rules to be followed for lead-based paint. So any home built after 1978,
You're okay, but prior to 1978.
prior to 1978, it made a difference. Now, here we are in 2023, we're getting further and further away from those homes. A lot of those homes that are being sold have been remodeled, and so someone has already had to deal with the lead paint issue.
Most often, yeah.
Bottom line, I'm here to help. In addition to the normal loans that almost everyone does, conventional and FHA, VA, rural housing, Utah housing, jumbo loans, we do all of those. Also, we can do another 45 or 50 types of loans where individual issues come up.
Right.
You might say the sky's the limit. And so, for example, just real quick. So, for example, say a person needs let's say they're self-employed and write everything off on their tax returns, we can do bank statement loans. Maybe you have an elderly couple that's ready to retire, we can do reverse mortgages if that's what they're interested in.
Okay.
Debt service coverage ratios for investors, lot loans, construction loans, both dual and single close construction. We can handle those types of things. Again, Kathy, I thank you for your time. Again, my name is Rick Hutchinson. I'm with First Rate Home Loans, and we'd love to do business with you.
Terrific. Thank you, Rick. Have a great day. Thanks for watching.